Hi everybody. The session of today has for objective to present you the best method rule under IRS regulations and to introduce a first example that will be then used in the second video in a bit more details to explain what are the 5 methods that can be used under this method rule. I hope everybody is well seated in your seats. Let's take off for this very important rule in transfer pricing. The 482 regulations actually provide for different methods that you can use to determine whether the transaction you are analyzing satisfies or not the arm's length standard. There are 2 points to be noted. The first one is that you have to select what we call the best method, meaning that you need to analyze very specifically the facts and circumstances around your transaction, and depending on the specific facts and circumstances, you have to choose the method that fits the best to the transaction you are analyzing. What does it mean, the best method? It simply means that you have to find the method which will provide you with the most reliable result in terms of either price or profit for the transaction under analysis. This is the first point. Second point to note, which is also extremely important, is that there is no priority around all methods that are suggested by the regulations. There is not one preferred method. The most important thing, again, to recall is that you need to pick up the best method to the case at hand. Let's go to a simple example to illustrate this rule. Here, as you can see, you have a Japanese company which is a manufacturer and which sells products to a UK company which is a related party and which is a distributor. In this specific example, this Japanese company will sell 10 units at a price of 7, so meaning our global transfer price is 70. You have the profit and loss accounts of both companies to illustrate the discussion. So normally, as you can see, the sales of your manufacturer, 70 being the transfer price, are exactly the same as the cost of goods of the distributor, 70. Then obviously the P&Ls are a bit different. The cost of goods of the Japanese co here are 40 and which leads to a gross profit of 30. Same gross profit for the UK company, the distributor, but for different reasons. The UK distributor will be able to sell on the market the products it acquired from the Japanese company at 100. Then they both have operating expenses, 20 for Japan Co, 25 for UK Co, leading to different operating profits, 10 for Japan Co, 5 for UK Co, meaning that for this group of 2 companies, we have a consolidated profit of 15. Why do we go into such a detail on the profit and loss accounts? Because this will be the basis for the decision on whether to go for one method or the other one. What are your options? First option is to simply look at the transfer price, 70, so meaning 7 per unit. And here you are selling 10 units. You could also focus specifically on your distributor and look at the gross profit, because this gross profit embeds the cost of goods, which is your transfer price. You could also look at the operating profit, and as you can see, the operating profit is much different from the gross profit because it integrates the operating expenses that the distributor is incurring while performing its activity. If you choose to go for another tested party, which would be the manufacturer, so Japan Co, you would have the same options. You could look at the gross profit of the manufacturer, here 30. You could also look at the operating profit, which is 10. And then you have a last option. The last option is to look at both Japan Co and UK Co and have a specific analysis based on the consolidated operating profit, which is 15. This means that you have a lot of options, meaning a lot of different methods, and this method will be analyzed in the second video, so hopefully I will find you in the second video. Thank you.